Hey guys, welcome to 101 Lending Review properly by us. So we went over Lending 101. I think we had two sessions that we covered the foundational knowledge we need to have as a loan coordinator, and obviously we like to add to that. But by high request, uh, Louisa and others, we are reviewing Lending 101. And we like to point out why this is important again. And I know, Ani, you weren't with us the first time, so this will be helpful. So I think as a real estate agent, we need to state the fact that the most important thing you need to buy a house is a loan. You need a loan, you need a down payment, you obviously need income to qualify for the loan, but having the basic knowledge of, you know, how to budget for your client, how to inform them of the documents they need to qualify, how much they qualify, and taking their mind really out of real estate shopping for a moment, the area and all their kind of dream, their dream home, bringing them to, hey, this is what you qualify. I know you want to buy in Glendale Hills, but you might not be able to. We might have to go to Granada Hills, for example, right? So we try to pride ourselves at Property by Us to learn information that would become handy when we sit down with clients. One of those is Lending 101. So all of our agents here get educated, get mentored with lending information, and I welcome anyone who likes to pursue that and become even a loan officer. So what I did in my career when I got my license, I studied lending and other things so I can be more informative when I sit with clients. And I think that says a lot. You will add value when you pass your business card. You will add value when you have the first opportunity to sit down with your first client because you will be more confident. You could answer their questions yourself versus Elizabeth taking out a business card and say, go to, so-and-so lender. So people like to deal with you as an agent as much as possible rather than you passing them along to other people. So with Lending 101, I know we covered the basic knowledge. So I thought what we'll go over that really quickly, like in 15 minutes, we just read it, and then we could practice how we do a free consultation when we sit down with our clients. So again, where we're gonna end up today is any of us that have an opportunity to invite a customer to our office and say, John, I invite you to come to our office for a free consultation to see what you actually qualify and what you need to qualify. So come on in and let's talk. So when they do come in, today we're gonna practice how we interact with them. But before we do that, let's just review the Lending 101. Anyone has those documents from the past? Wow, I'm surprised you guys have it. Okay. So, Meg, do you happen to have with you, let me see. You have it, I passed it to her. Yeah, I made copies, I passed it to everyone. So you have the one that says, let's see. Yeah, but let me see which one I want to start. Yeah, I want to start with Lending 101 LBU. Okay, perfect.
We're gonna show.
So, you guys gonna share, awesome. So I'm gonna just show this also to the camera. So we had this on the board when we did the class. So this is basically Lending 101 by Lending by Us. We are going to read through this, and first we start by defining qualified mortgage versus non-qualified mortgages and what are some of those loan titles, loan names. And let me just also, before Meg reads them, let me just remind all of us again. Lending information is a lot more detailed than what we have here. So what I did was I simplify it to a foundational 101 level for the sake of having a conversation with a customer. Now, if someone is watching this and says, Kevin, you know what, this is so much more, so many more programs, I understand. We are going to cover those things at a future time. So this is more like a baby step, okay? So if you don't mind, Meg, read us the type of qualified mortgages that they are first, please.
Sure. The qualified mortgages are full doc, conventional loans, FHA loans, and VA loans.
So let me define what we meant. When I say full doc, so when I sit with a client, if I tell them, oh, there's a qualified mortgage and non-qualified mortgage, they're not gonna know what we're talking about. So the language that I use to simplify it, like user friendly, I call it full doc or no full doc, not a full doc, right? So full doc and not a full doc. So when I sit down with a client, I say, look, there are really two types of loan. Full doc where you have to give all your documents, no doc where there's programs that if you put enough down payment, you can go with stated income, you can go with bank statements. So there are either limited documents or there's sometimes very little or no documents, okay? So on a full doc, we have conventional loans, we have FHA loans, VA loans. These are some of the more popular, but it doesn't mean that it ends there. On a not full doc, we have bank statement loans, VOE only loans, and DSCR loans. Now again, it doesn't mean that there's no documents involved. For example, in a bank statement loan, we talked about they're gonna want 12 months or 24 months bank statements, okay? And other documents, but it won't be as full as a full doc loan. It won't be as many as a full doc loan. Okay, let's go to the second paragraph. So on full doc items. So some of the items we need for a full doc, if you don't mind, Beck, you take it.
Sure. We need the latest 2 years of tax returns, latest 2 pay stubs, and 2 bank statements.
So again, this is just for customers and so if I'm sitting with a customer and the client, I apologize, and client goes, so Kevin, what are the typical documents the bank is gonna ask me or you guys are gonna need? I'm gonna say, well, we're gonna need your last 2-year tax return, we're gonna need your last 2-month bank statement and your last 2 pay stub. Doesn't mean that they're not gonna ask for 3 or 4, sometimes they do, but this is generally speaking. Now, we also talked about, these are some of the documents you need for a full doc. So I'm just gonna go a little bit quicker. So on a conventional loan rate ratio, we talk about confirming loans up to 726,200. Now that changes a lot. So we're recording this in 2023 April. It might change next year. High balance up to 1,089,300. Jumbo is more than a high balance. So these were just two for customers. And let's say you're sitting down with a customer, Caroline, and the customer tells Caroline, wait a second, you're telling me my rate is 6.5, but my sister just got a house and the rate is 6. Why is it higher? Well, one reason can be the loan amount. So if the loan amount happens to be confirming, which is under 726, that rate is usually less, right? So let's say Caroline's client, sister had a loan for 500 and the client who's sitting in front of Caroline has a loan for 900. Well, those are two different categories, and that's what this is important. Conventional loan key elements. What are some of the key elements in a conventional loan? You can put a 5% down, as low as 5% down. Less than 20%, we have private mortgage insurance, PMI. Once 20% equity is in, PMI is out. So these are some of the highlights of that type of a loan, which is conventional. For an FHA loan element, we can go as low as 3.5%. It has mortgage insurance premium for the life of the loan. There is an exception that if you put 10% when you buy the house, 11th year, we could take it out. It's not available in all apartment condo units, right? That was another kind of like a bad highlight. So if you have an FHA, you and let's say your boyfriend want to go buy an apartment, some of the apartments don't accept FHA. And how do you find that? You ask the HOA, homeowner association. It allows for a lower FICO score. So if you have a client sitting in your office and they go, you know what, my FICO score is lower, I have too much debt. The credit is okay, but because of filling up the credit limit, their credit score is less. Well, FHA allows you for a lower credit score. And sometimes when they refer to a first-time buyer, it's because a lot of first-time buyers, they might be kind of building their credits, so they might not have too many credits, so their FICO score might be lower. Okay, guys, so some of the highlights on a bank statement loan. In most cases, you have to put 20% down, but it changes. Right now, we have a program that if you're buying up to $1 million, you could do it with 10% down. There is a boutique lender that does that. For a bank statement loan, DBA or corp ownership or some type of a business ownership, it's a 12 months business bank statement loan in most cases. Sometimes it's more, but most cases we can do it with 12 months. And another thing to notice, any program that's a non-QM, like a not a full doc, the rates will be higher, okay? VOE only, so this is a verification of employment only program, again, 20% down, higher rate, no business or corporation someone should have. So if someone says, I work for JCPenney and they own a company that they sell clothing store, that, you know, you cannot be in two places at the same time. Okay, those are some of the highlights and basic information regarding lending before we do the consultation with our customer. The other thing we talked about is some of the definitions, right? I know we had all this on the board and we discussed it, but let's read through it really quick just to remind ourselves. If Meg, you want to read loan to value for us?
Sure. Loan to value, LTV, for short, ratio is a measure of comparing the amount of your mortgage with the appraisal value of the property.
So guys, you remember loan to value? So what is your loan according to the value? How you get the value is when someone appraises it, right? So let's say if the house get appraised for $1 million, and if your loan is 800,000, right? So that's loan to value. 800,000 loan, you're putting 20% down, and it's $1 million. So if you're putting 20% down, you don't have mortgage insurance. Then we talked about debt to income ratio, DTI. Natalie, do you have it?
Yeah.
Okay, you want to read the DTI?
Your debt to income ratio compares how much you owe each month to how much you earn. Specifically, it's a percentage of your gross monthly income before taxes that goes towards payments for rent, mortgage, credit cards, or other debt.
So we talked about DTI. It's really important for us to understand that the DTI, it compares how much we really owe each month versus how much we make, okay? And we go down the chart to understand that calculation. So let's go to how is the DTI calculated? In the back somewhere, anybody has that? Louisa, do you have it?
Which one?
Louisa, do you have it?
I have the paper, but which one?
How is DTI calculated?
Yeah. To calculate your DTI, you add up all your monthly debt payments and divide them by your gross monthly income.
Okay, so you add up all the debt, you divide it by the gross income, right? Go ahead.
Your gross monthly income is generally the amount of money you have earned before your taxes and other deductions are taken out.
Okay, so let's do that. So let's put a client here, John. Melody, if you don't mind turning that off, please.
Sure.
Okay, so let's put a client here, John. So we have CC, credit card. We have student loan, okay, for John. We have, let's say, private loan. He has a private loan with One Main Financial. And we have his housing expense, okay? So let's say he has all his credit card. Let's say he has 2 credit cards. Minimum payment for each is $30. That's what they take account. What are you obligated to pay the minimum payments? So 30 and 30, he has a $60 here monthly. Student loan is $100 a month, let's say, and has a private loan that he pays $400 a month. And let's say the housing expenses, we did all our calculation, and that's $3,500 a month. Oops. Okay, so who can tell me what are some of the items in the housing expenses? Who can tell me what some of those items are?
The monthly payment,
Yeah, what's in there?
The
tax, the property tax,
So let's put them down, okay?
mortgage payment.
So you said principal, right? Plus interest, okay? You said property tax, right?
and insurance.
Okay,
EMI,
hazard,
yes.
insurance, And if it happens to have a condo, it will have HOA, so this we can put, well, some houses have it, but very few. And then we said maybe PMI, right? For example. So in this example that we're doing, to come up with our DTI, debt to income ratio, John has these payments, okay? Somebody take out their phone, please, and add all of this and see what total we get.
Can I ask something, Kevin?
Yes.
When we calculate DTI of a buyer, we calculate what they're spending then, not in future, to see what type of a loan we can get. Am I right? For
You're
example,
right, but
if
you
they
have to-
rent, do we have to do that?
Okay, so let me answer that question correctly for you. So where you get this information, with the exception of housing expense, where do you guys get that information? Anyone?
From the loan officer.
Yeah, but where do you get it? From the loan
From
office,
the
correct?
your client.
No, where do you get that information? I want to know where you get it. Harry, where do you get that information?
As loan estimate.
Sorry, I didn't ask you that.
Where do you get the information of credit card monthly payments, student loan, private loan, without housing expense? Where do you get it? Credit report. So you gotta have a credit report. So I'm answering your question now. Part one, you have to have a credit report. So I get all of this information from my credit report. When you do a consultation, you ask because you don't want to pull their credit right then and there. Why you don't want them? Because they came for a consultation. Okay, we don't want to be aggressive. We want to be informative. So once this is being done correctly, use a credit report. Now, that up to here, the housing expense is something you're going to estimate because they don't have a house. It's not the rent. Rent, cable, electricity, gardener, pool, shoe shopping, none of that has to do with this. What is shown up here is anything that's in the credit report. So the debt to income ratio, the word debt is defined of what the items you find in the credit report with the addition of the housing expense. And how do you get the housing expense? Is what we're gonna do later. You're gonna ask John, what's your max budget? John says 4,000. And then you start calculating how much of a loan he can get. Then you take that loan and you put it there, basically. So even if you ask John and John says, I don't want my mortgage to be more than 35. So I ask Ani, you and your boyfriend want to buy a condo. What's the max you guys can afford? If they say 3,500, that's good enough. Just put it up here. That will cover everything because that's their choice. So 3,500 for their household expense, and all of this is on their credit report, both, let's say wife and husband. What's the total, guys?
It's 40,060.
4060? Okay. This pen wants to say goodbye to me. So let me get another marker.
And they always go with the household, right? The
I'm sorry?
household expense, not like just wife
Well,
or husband.
Well, it depends who the borrower is. So if, excuse me, if a married couple decides just to go under the wife, then it will just be talking about the wife here. The housing expense is a housing expense. A borrower's expense, it depends how many people are on a file. So if Ani makes 4,000 a month and her husband makes 6,000 a month and they need the 10,000 to qualify, well, we're gonna have two borrowers. So if she has a car under her name, pays 400 a month, and her husband pays 600 a month, now the expenses for the, and we actually didn't put the car here, so let's say John doesn't have a car. He lives in New York and takes the bus. But we have to put both cars in. So it's always good to have more borrowers because hopefully they have sourced income that we can use, right? So let's go total, and you guys said 4060, right? So this will be total debt, right? Oh, look at that marker, now you can see. Okay, 4060. Now, what does this say? Again, it says to calculate DTI, you add all the monthly debt. We did it, and we divided by the gross monthly income. So we'll ask John, please provide me your last two pay stub. I look at it. Let's say I happen to come up with, let's say, total income, and we go with gross, right? Let's say I happen to come up to 9,200, and this will be gross monthly, right? So this said, once we add this up and we divide it, right? Divided by the gross monthly income. So we go 40, 4060, right? Divided by 9200. Somebody do the honors, please.
It's 44%.
You got 44? And other people? I just want to make sure that Morgan is using an American calculator.
Yeah, I think.
44?
Yeah, can.
Before you ask your question, one more person tell me.
Minus 244.
Okay, so guys, 44, I know there's percentages, so this is the DTI. So this is what we got, right? Okay, so we have the DTI for John. Now, if we continue reading the next division, DTI division bracket. So for conventional loan, 46%, and we put may go as high as 49 in some cases. So if a conventional loan allows you, Ani, to have a 46%, sometimes even as high as 49, does John qualify for a conventional
Yes.
loan if the DTI is 44? Yes, because it's 46 or 49. This has to be 52 for us to say no. 44. So anything under 46, John qualifies. Everyone with me?
Yeah.
With me? Okay.
Anything under 49.
49. But to be safe, 46 solidly, you know? 49, it depends on the credit score sometimes and goes to more of a detailed
Yeah.
lending, analyzing kind of. Okay, so now this is the DTI division bracket. FHA loan allows you to go up to 52. So let's do a second scenario. So we call this scenario number 1 for John. We'll do a scenario number 2 for John. Now, what if John made, let's say 8,500? Well, let's actually even, sorry about that, guys. Let's make it 8,100. So what if total income for John was 8,100 a month? Can somebody do 8,100, 4060 divided by 8,100 and tell me what you get?
50%.
Everybody got 50? Okay. So now this is our DTI. So there is a good chance that we might have to do which loan? We might have to go to FHA. We might have to go FHA. Okay? All right, guys. So moving forward, what is the front end in a mortgage and what is the back end in a mortgage? So front end ratio is often called the housing ratio. So this, what we did here, guys, is called the front end. Okay? This calculation shows what percentage of your gross monthly income will go towards the housing expense. This includes mortgage payments, property tax, homeowner insurance, and any HOA dues. So what does it mean? In a practical sense, in scenario number 1, if John makes $9,200, 44% of that goes towards what?
Housing.
Thank you. Goes towards housing. That's what it is. 44% of John's income goes towards housing expenses, right? What is the back end ratio? The back end ratio compares what portion of your income is needed to cover all of your monthly debts. Actually, let me stop that and backtrack. I apologize. That was incorrect.
Yeah.
So, 44% of John's income goes towards all of the expenses we have here. So that's the back end, not the front. I apologize, okay? If you wanted to do the front end, how do we get that, Joel? How do we get that? Well, we take 3,500, right, Joel? And we divide it by 9,200. What do you guys have? Let's do the front end since I mentioned it.
38%.
38%. Thank you, Joel. 38%. I apologize for the rough looking 3. So 38 would be the front, which means that would be 38% of this guy's income is covering the housing expense. 44% is covering everything. What is he doing with the rest of his 56% income? He's traveling to Egypt and France, and he's buying his wife a lot of nice clothing, just spending his money. He's living his life, paying the electricity bill, paying the gardener, saving money for the kids' college, etc., etc., etc. Okay, so guys, we did a quick review. I know this was very short and quick, but this was a review. That's a wake-up call that we're ready. That was a ring. We were ready for us to take the practice now, kind of like the practice exam. Okay. So thank you so much for that cue. I appreciate it. Okay, no, we're just not, Caroline. We're not going anywhere. I'm sorry about. You can go outside and make the call, but we're all here. We ain't going nowhere. We're gonna have two. Remember, we did all this to do the. You have a pen and paper. We haven't used your pen and paper. We're just. No, we got about 10 more minutes to go, Caroline. 10 more minutes to go. Okay, so guys, let's do 2 quick examples. Okay, and we do 5 minutes for each, and I promise Caroline that we'll be done in 10 minutes. Okay?
Take your time.
Okay. No, the alarm just came on. That's my cue, like 10 minutes cue. Okay. So let's go to our first client. So let's put Jim, okay? So let's see. Jim is gonna have these expenses. So total expenses, okay? Perry, do you mind taking care of Jasmine?
Sure, she pulling it?
Yeah, you can take care of yourself. Okay, total expenses, guys, okay?
Sorry.
So Jim has a car payment, monthly payment of 500, has credit card 0, student loan 50, and yeah. So the proposed housing expense of $3,000, okay? Now, total for Jim, income, we're going to do so if everyone gets me the DTI, we're just gonna do the back end, guys. We're just gonna do the back end, which means total expenses, total income. What do you guys get? You already did it? Okay, so everyone else take your time. Melody is trying to rush to get out of here. Her alarm came on. 46, okay. So, 46%. Okay, and really quick, now we're gonna close this session today with what we started for. What we talked about at the beginning, Elizabeth, was if you invite your friend for a free consultation, you're gonna ask 2 questions after you guys sit down. So you say, hey, Tracy, thank you so much for coming. Would you like some coffee? Once you've done all your chit chat and Tracy sits down, Tracy's gonna wanna tell Elizabeth about her dream home. Give her a minute, give her 2 minutes, let her tell you about your dream home. But then Elizabeth wants to ask 2 key questions to bring her mind in to see if she qualifies, if Tracy qualifies for the dream home. What are the 2 questions we ask, guys? What is the number 1 question, someone, please?
What are your liabilities?
Okay,
What's your
not exactly what are your liabilities. I want a better question.
What's your maximum you can pay monthly?
Okay, so it's the one question you ask is what is
Budget.
your max monthly, right? Budget. So, sorry, I'm writing this fast. What is your monthly budget? And you're gonna tell Tracy, I know you have a car payment. I know you have your lifestyle, but think of like what you're paying for rent. What is the maximum you could pay every month? And this would include everything for your mortgage, including property tax, including HOA. And let's say Tracy turns around and says $4,500. And then what is the second question we asked Tracy, Elizabeth?
How much do you have in your bank account?
How much do you have in your bank account? So how much have you saved up? Now we talked about how much have you saved up, obviously to buy a home. And a lot of my clients in the past, they say, I want to put 10% down, 20% down, but sometimes that doesn't help. I need a dollar amount. So let's say Tracy turns around and says $75,000, okay? So now we'll tell Tracy, okay, Tracy, I know your max budget. I know how much you have. I'm gonna tell you actually how much you can afford. What house price can you get that you won't be stressed with the bill, that you could afford it, okay? So now all of you guys take this scenario and tell me what can she buy, okay? Take this scenario and tell me what she can buy. So you gotta go to a mortgage calculator.
700,000.
Okay, you gotta go to a mortgage. It's not fair because she has a computer. She goes fast as shit. She has a desk. She has a desktop. Okay, so you guys gotta, and the way to maybe do it, when you go to that mortgage calculator, start with 500,000 purchase, put the 75,000 down, and see what the total payment comes, and then from there you could go up or down, right? So put 500,000 purchase in a mortgage calculator. You can find a mortgage calculator, Zillow, Redfin, Home by Kevin, you know. So anybody else got around? And remember, it's going to be estimated around, so it doesn't have to be exactly 700,000. But anybody else got that 700,000? Or anybody else did it yet? I know it's hard. You guys are going on your phone.
Okay, I try one time. Can you show me where you put it? Because I usually do it in my head, but when I do it here, I don't get any result. I don't know
Okay,
what
so
you
let's
put
do
in
it
there.
together. I'll show you, but let's do it together. Can everyone go to homebykevin.com, please?
Yes.
Go to resources and go to mortgage calculator. Everyone go there, but I want to do it together. So everyone go to homebykevin.com, resources and mortgage calculator, and let me know when everyone is there. Are you there, Joel?
But I just don't get the result. I usually do it in my head. Because
Are you
once-
there? Are you at the mortgage calculator?
Yes.
Okay.
I just
So everyone,
Okay,
when you're
result.
there, do this. Put the down payment first. Put 75,000 in down payment, please. Okay. And everyone, where it says purchase price, please put 500,000. Let's just start in the
so
middle.
just come up with a number. That's
Start with
what I did.
500,000.
Oh,
Let's put
okay.
that as our default. Start with 500,000.
That's
What do
fine.
you get, Caroline? Did you do? Caroline doesn't look like she did it. Whoever did it, what do you guys get with 500,000? Except Melody. Someone except Melody.
Interest rate of 6.5?
Yeah, good
Yeah.
question. Let's do the interest rate 6.5. Very good question.
I don't get the result.
What do you guys get? Somebody beside Melody, please.
3,232.
3,000? Louder?
3,232.
Okay, so what is Tracy's budget? 4,500. So what do we change? Anyone?
The
The
list
purchase price.
Thank you. Go up. Now go to 600 for me. Everyone go to 600 and tell me what you get. See, if you start with 500, you can practice from there and go up until you get the hang of it.
So it's 6.5, right?
Yes.
So you get 4,000, 3,971.
3,900. What's
And you
her
have
thing?
to add PMI too.
You have to add PMI too?
Yeah.
Yes, but you have 3,900, right? Okay. Now, how much did you guys put? 6? Can we go to 650?
640.
650? Let's go to 650 for now.
4,342.
Okay, let's stay at 650, everyone, okay? So 650, you get 4,000, how much, Joa?
342.
4,342, right? So then we add a little bit for mortgage insurance. Again, this is estimate.
Around it.
It could be 700, right? But estimate is around 650. This is a free consultation to give them an idea. It's not exact numbers because this is your. We don't even have any documents to do. This is just to do a consultation. So Elizabeth will tell Tracy, hey Tracy, you know what? You can buy around 650. If you're gonna buy a condo, it might be like 630 because you have a little bit extra. If you want to stay at a $4,500 range. Now Tracy might say, you know what, Kevin, I want to go 5,000. Next week she calls me and says I want to go 5,000. Calls Elizabeth. Then you could take the loan higher. This is just to tell them what budget gets them what house. Now, do they qualify for that loan?
Yeah.
Do they qualify for a loan of 600 in a 650? That's another class, another session. That's a whole other story. But before you ask them for documents or ask them their bills, first you want to have a foundation. How do you get the foundation, guys? invite them to the office at Property by Us, have a sit down, ask them 2 questions. How much is your max budget? How much have you saved up? So in conclusion, I wanna leave you guys with this thought. Any of you, even you, Ani, you can go to your mom, your boyfriend, any of you, can go and do a scenario with them, just for fun. Tell your boyfriend, say, hey, if one day you were to get a house, how much would you like to spend on your mortgage? That's your everything. Property tax, we're not talking about electric bill, cable, or anything like that. We're talking about housing, like rent, which is in a purchase would be mortgage, property tax, insurance, and etc. So let's say I don't want to pay more than $4,000. And then you say, okay, when you're ready to buy a house, how much you think you're gonna save up? Let's say he say 100,000. Take the 100,000, put it in the mortgage calculator down payment. Start with a 500,000 as a purchase until you get to that number that he or she is telling you. And you could tell him an idea. With this scenario, you could buy around this much. So what this does is puts the client's mind in perspective, align with reality. Because I've had a lot of clients come to me and say, Kevin, Perry, I think
Don't worry about it.
you're good?
I'm good.
Okay. I have a lot of clients come to me and say, Kevin, I want to buy a nice house in Glendale Hills, north of the mountains or north of Kenneth. And I tell them, well, how much do you want to pay every month? And then they say a number that doesn't match up to that. So by doing this, you can help them align their goals with their desire. Because the idea, and this is what I tell friends, family, clients, the idea of is buying a home is to make memories. The idea is buying home is to grow the money you work hard with by putting it in dirt. The idea is not to get stressed and not be able to, God forbid, pay the mortgage and lose your asset, right? So the first thing before I think about how much commission I make, obviously the more I sell, the more price, the more commission. No, the idea is working for our clients, making sure they can afford, making sure the step they take, telling them about the future, and that's what I think sets us apart as an agent, that we could have a healthy relationship with them and helping them to get to their goal according to what they can afford. So this is a quick review of Lending 101.
I have a question.
Sure.
That monthly, gross monthly income is for people who do W-2. But like when it comes to people that they have business 1099, then this is not the case, right? We have to find out what's their net income. Is that correct?
So as usual, your questions are good, but they're for like a different class, but let's answer them really quick. So even somebody that has 1099, at the end of the year, they have filed their taxes. So how do I come to that income? What was my income? 77. Well, I get their tax return, right? I look at their net income and I divide it by 12 and I could still come up to that. So you can get your income in different ways. One is W-2 and one is based on Schedule C or tax returns. But to open that, because there's so many different ways, there's so many different places, that's a different session, a different class. This is just to introduce. How to calculate income is a different class. How to do different types of program lending is a different class. But you could have a borrower that doesn't do W-2 and is qualified for even $15,000 a month, $20,000 a month.
And then another general question, like the more down payment you put, the better interest rate you get. Is that right? Or for example, 10% versus 20%.
So it is correct, but to get a better interest rate, a lot of factors play in. One of the factors that plays in is what you said. One of the factors.
Yeah,
But the main factor that plays a role in getting a better interest rate is your credit report, your credit score.
I understand. Let's say it's a customer says I just want to put 10%, and you say with whatever your situation is, your interest rate is gonna be 5%, for example, and then they change their mind and say, okay, I want to put the 20% instead. So then the interest rate is gonna go down instead of, all its situations same, except the down
It
payment.
will. It
Then
will.
it goes
It will.
down under 5%.
It will. It will. But
Because
a lot of
often
factors.
is asked by people, I wanna
A-
get them the right push.
So the right answer would be yes, it does, but a lot of factors play into that. You have to tell them that a lot of factors play into that.
Yeah, I felt that, I'm sorry, no, I felt that when we just do the meet talk, it's just a guesswork, because I'm using this calculator that when I put
Yeah.
$100,000 as a down, I get lower rate. When I put $75,000, I get the tiny bit higher. I guess it's, and you have all the details, but I guess everything is just a guesswork.
So two different things. What she's saying is correct. So when we're doing the meeting, it's an estimate. It's a guesswork. What you're saying is you have sometimes client come up to you and say, "Hi, Louisa, I have a question. If I put more money down, will I get a better rate?" In most cases, yes. But there has been cases that whether you put 10 or 20% down, you get the same rate. Many cases. So it's a factor. It's not a guarantee. A lot of things play into, like when the rates were down, we had clients buying and getting the same rate sometimes at 10 or 15 or 20% because other factors about that client was playing a big role into coming up with the final rate. So in most cases, yes, but other factors play a role too. Any other questions, guys?
Does it have to do with credit score, or is it?
Credit score is the main factor. So what drives the rate? Again, there's a lot of factors, but the biggest one would be the credit score. So the higher your score is, the better rate you get. The lower your score is, the higher rate you get.
But again, what is the range? Let's say 700, if you have a score of 700 and 740, it would be the same?
No. So it changes by very little. By very little, it changes. Typically, again,
Yeah.
a lot of things play a role, but typically if your score is over 760, over 750, you get the best score. You get the best
Right.
rate.
But anything, let's say between 700 to 760 is kind of
No, it changes a little bit.
changes. a lot.
Very little bit. Very little. Like on the payment, it might be, $50.
But what is generally for like conventional? If you want to get approved for a conventional, it's like lower than 700 is acceptable or not?
So that changes sometimes depending on the marketplace, but generally speaking, for a conventional, the lowest FICO score you could have, generally speaking, it changes is 680. But again, there's different programs, different loan amount, a lot of things play a factor. So these type of questions, I would say if a client asking you, you have to get a scenario from the client, right?
Yeah.
Ask the loan amount, ask some question, ask the FICO score, and then take it to the processor. That we have, and the processor will look at that scenario and give you a more accurate answer. Any other question, guys? No? Awesome. Okay, guys. Thanks.